Welcome everyone to this corporate reporting class. My name's Kieran Doe. I'm a senior tutor at ACA Masters and multiple ICAEW prize winner. In this class, I'll be working through an exam standard question to demonstrate the exam technique to use for question 2. After this, I'll offer my advice on how you should approach the CR exam and your preparation for the exam. We'll then have time at the end for some questions. If you do have any questions in the meantime, feel free to type them in on the chat box and I'll pick them up as we go or at a suitable point if it's something that we are going to come on to. So question 2 in the CR exam will be on financial reporting. So there won't be an audit element to question 2 in the exam. So for those of you who prefer the technical aspects of the exam, the financial reporting, then this probably suits you quite nicely. So question 1 and question 3, of course, will have audit in them. So the question won't be exclusively financial reporting, or unlikely to be. It's quite likely that you might see some of the other question types in there, such as financial statement analysis. That's quite common to see that in question 2, and possibly ethics as well. So it doesn't have audit, it will be primarily financial reporting, but it might have some of the other question types. And we'll talk about the various question types that we see in the CR exam shortly. So as with all questions, I always suggest looking at the requirement first of all, so you can see what you have to do. We've obviously got our 30 marks here. And if you find the requirement, things that we need to do, then you can identify what we need to do and you can see which exhibits relate to each question. So set out and explain for each of the 3 issues in Exhibit 1, your recommended financial reporting treatment in ICAEW's financial statements for the year ended 30th of June 22. Include correcting journal entries. So this is quite common, and as you'd expect in this question, all question 2s require you to explain the financial reporting treatment, and we've got 3 issues here in Exhibit 1. So it's very common that you'd have a series of issues to work through and just explain the financial reporting treatment of each. We can see we've got the 3 issues here, so that's very standard. And then we've got the draft financial statements in that same exhibit. So we can see for the second part of the question, it says prepare revised draft financial statements for ICAEW for the year ended 30th of June 22, Exhibit 1. So we need to revise the draft financial statements suitable for publication, which include your adjustments from part 1 above, show your workings. So again, a very typical question to this. For the first part, you have to explain the FR treatment of a series of issues. And then for the second part, you have to revise the draft financial statements, which kind of makes sense really. We've got the draft financial statements here. We're usually told there are a series of transactions which either haven't been dealt with yet or dealt with incorrectly. And therefore, what we need to do is take each of these issues one by one. We need to explain the financial reporting treatment, but then what we also need to do is correct the draft financial statements. So you can see, even though these are like 2 separate requirements, you can see they're interrelated. You've got the 3 issues. For each issue, what you're going to need to do is explain the FR treatment, but you also, for this part, need to include the impact on the draft financial statements. So I'd always see these 2 types of question, these 2 requirements as interrelated. It's almost like they're one requirement really, and they'll explain in words the FR treatment and then show the impact on the draft financial statements. So then the other requirement we have here is evaluate Raj Ahmed's draft analysis of ICAEW's financial performance and position, include any relevant additional analysis use your revised financial statements. So this again is a common requirement in the CR exam, not always in question 2, but I think this type tends to be in question 2, when we have to analyze the financial performance and position, so financial statement analysis. We can also see this type of question in the audit questions, and we're usually doing it from the auditor's point of view, so undertaking analytical procedures usually to identify risks or perhaps to gather audit evidence. So we can see here we have this for the later part, and we're using our revised financial statements here, and we've got Exhibit 2. So if we look at the exhibits overall, we know we've got the draft financial statements, which we're going to have to correct as a result of these 3 issues. So we need to explain the FR treatment for each of these 3 issues and overlay any adjustments to the draft financial statements. And then we've kind of got this separate requirement where we have to look at the draft analysis which has been performed, and it looks as though we're going to have to undertake some of our own analysis. And it says here, evaluate it. So perhaps there's going to be some issues there in the analysis which has already been performed. So I definitely see this as a kind of separate requirement here. As we said, the first 2 are interrelated. You're going to have to go through each issue, explain the FR treatment, and then overlay the numbers to the draft financial statements. But once you've done that requirement, so these first 2 parts, and you've got your revised figures, then you can undertake additional analysis to evaluate and analyze the company's performance and position, and evaluate the work that has already been undertaken. So I definitely see that as kind of a subsequent requirement. I do these 2 first, and then I'll do this one, that naturally comes after. And you can see we've got Exhibit 2 here. So all of that is in Exhibit 2. So I won't even read Exhibit 2 for now. I'm just going to focus on doing this first part of the question, these first 2 parts. So what I always suggest doing is try to estimate how the marks might be allocated so that you can weight your time. Obviously a very time pressured exam, and what you want to try and do is make sure you attempt every requirement, because there'll usually be some easy marks on each. It would be a shame if you spent all of your time doing these 2 and didn't even get to this, because there'll probably be some easy marks here. There'll probably be some really hard points as well, but if you at least get onto it, you can get those easy and those medium points. You can grab that low-hanging fruit. So when you're trying to allocate your marks, there's various approaches you can take, but I would always say allocate 8 marks for ethics. Now, we don't have ethics in this requirement, unfortunately, but when you have financial statement analysis, it tends to be around about 8 marks as well. So sometimes it varies, sometimes it might be 10, 12, maybe slightly less than 8. Similar with ethics, it can be between 5 and 10, but as a rule of thumb, aim for 8. So I'd say 8 marks here, and therefore, as I said, I'd consider this to be kind of like one single requirement. So I'd have like 22 marks here for these 2 bits, and then you could kind of allocate your time like that. So maybe do 2 minutes per mark, so just kind of rounding it down slightly to allow for some reading time. Or you can do this other ways. You could actually kind of factor in some reading time as well. It's not an exact science. It's just important that you leave enough time to make sure you attempt this part of the question. So I'd allocate 8 marks here, and have 16 minutes here, and then have the 22 marks for these 2 parts. And you could even subdivide that further, because of course you've got the 3 issues. So then you could do the 22 divided by 3, so kind of about 7 marks per issue, including explaining it and adjusting the draft financial statements, because then that will ensure that you attempt every issue. Same principle applies here. You don't want to spend all of your time on the sale and leaseback, and the share-based payments, and not getting onto the final bit about loan finance. So even though it's probably financial instruments, a tricky technical area, there will be some easy marks here. So you want to make sure that you attempt every issue as well. So again, try to allocate your time to each kind of subpart to the question and kind of each issue, just to make sure that you attempt everything. I think it's really important that you try to attempt everything on the paper, so that you can kind of get the easy and medium marks on each. And it isn't unusual for issue 1 and issue 2 perhaps to be slightly harder than issue 3. So it's almost can feel like a reward sometimes if you allocate your time and you attempt all of the issues, and the later issues, maybe issue 3 or this part of the question is actually relatively easier, perhaps, particularly if it's ethics, which is probably slightly easier than some of the technical marks. So hopefully that's kind of clear on why you should allocate your time. So allocate the marks to each requirement and therefore allocate your time so that you can attempt everything. We'll talk about that a bit more at the end. So yeah, do let me know if you have any questions on that. So then once you've had a look at the exhibits, you've had a look at the requirement, we've kind of got a plan of action now for this question. We know what we're going to need to do is explain the FR treatment. So what you could do either now, or you could do it once you've read the bit at the start, is you could think, okay, well, I'm going to explain the FR treatment for the first part, and we're going to start off with the sale and leaseback. So now I'm going to take it one issue at a time. I'm going to explain the FR treatment for the sale and leaseback, and then what you can do is you can copy over the numbers you need from the draft financial statements. So it's the current year we're going to need to adjust. So you can copy over the statement of comprehensive income. So we've got the P&L and the OCI here, and the SFP. So you could copy over your draft numbers here. So we'd start with these as the draft numbers, and then we're going to have an adjustment. So we're going to have an adjustment for issue 1, and then we're going to have issue 2, issue 3, etc. And then we'll get to the final numbers. So that what we can do is we can take it one issue at a time, explain the FR treatment, and then immediately after overlay our numbers onto the draft financial statements. So tackle both parts at once. Now, it makes sense to do it like this because once we're going to explain the treatment for the sale and leaseback transaction, we've got sale and leaseback, on our mind. We're explaining what should be recorded in the P&L, what should be recorded on the SFP. So therefore, it makes sense to just immediately overlay that onto our figures, and then we're kind of done with sale and leaseback transaction, and then we can move on to share-based payments and focus on that, rather than explaining it for all 3 issues and then coming back to it and thinking, oh, well, now I need to draft the financial statements, and then you'd have to kind of trawl back through your answer trying to find out what exactly it was that the impact was going to be. And this will become a bit clearer why this is beneficial as I work through the question. So once you've allocated your time and you've identified what's in each exhibit, we know, for example, we don't need to read exhibit 2 for now or pay too much attention to anything which is explaining about the performance and position, because we'll come back to that. So we've got a good feel for how the question is structured. What you usually get here at the start is a brief kind of explanation of the company, what the company does, what your role is, and it usually just kind of almost like summarizes the requirements again, perhaps explains them in a bit more detail. I'm not saying this part isn't important. You should absolutely read it, but I'm just kind of explaining that this is generally in the same format each time. And if you've actually looked at the requirements and you looked at the exhibit, it tends not to tell us anything that's really new or surprises us. So we're being told that iClean manufactures robotic vacuum cleaners, mops, and lawnmowers. So it's a manufacturer. And therefore, you'd probably expect on the financial statements that it'd have quite a bit of PPE, because if it's a manufacturer, it's going to have some plant and equipment, and we can see that there. You can, of course, see, it's been a profitable business as well. So 30th of June year end, as we already knew, because we know what date we're drafting the financial statements to. It does not have any subsidiary companies, so we're not going to have any group issues in this question unless there's associates and joint ventures and things like that. But looking at the issues, it doesn't appear as though that's the case. Functional currency is the pound. So we're told that 60% of the ordinary shares are held equally by the 5 directors. So there's 5 directors, and between them, they own 60% of the shares. They're held equally. So therefore, we could work out, what percentage the directors have. So therefore, they've all got 12% each. And the remaining 40% are held by private equity investors. So it doesn't sound as though it's a subsidiary of another company either. we're told that ICAEW will seek to obtain an AIM listing, so a listing on the alternative market, not the main market, in 2025. So then we can see ICAEW has experienced rapid sales growth since it was established in 2015. So we're told that they've undergone a rapid sales growth. So maybe this is going to be relevant for the performance part. It's only been business a few years, as you might expect with a high-tech company like this. Industry experts predict that the market will grow by an average of 25% per annum over the next 5 years, or between 2020 and 25, as the use of robots in everyday life increases. So this might be relevant when we're looking at the performance of the business, because we're told that the market is expected to be growing at 25% per annum. So that's something we could benchmark the company's performance to. But again, that's going to be more relevant for the later part, so I wouldn't think too much about that now. Maybe just highlight it and think, oh yes, I'll definitely be using this for that part. As an innovative business, ICAEW has invested heavily in R&D, which has enabled its products to incorporate cutting-edge technology, as you might expect in this type of industry where they're using robots. So we're told they invested heavily in R&D, and of course we can see they have capitalized some of this expenditure, because we can see it here in intangible assets. Maybe some of it qualified for development costs and therefore had to be capitalized under IAS 38. Maybe some of it with research costs and therefore expensed. And of course, it'd be the amortization on any capitalized costs in there as well, unless in the rare event they had an indefinite useful life. So we're told technology used in the industry is changing at a fast pace, and the directors are aware that ICAEW must continually invest in R&D in order to maintain a competitive advantage. Again, maybe we'll see some R&D in some of our financial reporting issues. I don't think we did actually, but maybe this is relevant for that performance and position part. So you work for a firm of ICAEW accountants. You have been seconded to assist ICAEW with the preparation of the financial statements for the year ended 30th of June 22. ICAEW is not an audit client of your firm. You report to the finance director, Akin Omar. So Akin called to give you the following briefing. So here we're told a junior member of the finance team, Raj Ahmed, has been helping me put together the financial statements for publication, but we need your technical expertise. Raj has prepared draft financial information for the year just ended. He's identified 3 financial reporting issues. So you can kind of see what I mean. These bits, they kind of tell us what we'd already kind of gathered by looking at the requirements and looking at the exhibits, but still important to read through it. Then we're told the last 2 years have been a period of remarkable growth. As part of the management commentary in the financial statement, so the part which goes in the annual report where the directors explain how the business has performed. So you can see it's telling us about this. They want to emphasize the impressive performance to support a bank loan application. Raj has done the draft analysis. We know this is for this part of the requirement. We're focusing on this bit first of all. So I'll probably just kind of leave that for now, just maybe briefly skim it to make sure there's nothing important there. But clearly this relates to this part of the requirement. And we said, it's best to tackle these bits first of all. So we know we've got these 3 issues to deal with. We've got our draft financial statement numbers. Let's just take it one issue at a time. You might want to have kind of a quick skim through the draft financial statement, see what we've got going on here. We didn't have a breakdown of cost of sales or operating costs, but of course we can see, so you could look at it here or you could look at it on here, but we can see, of course, it's a profitable business, a small amount of finance costs, but profitable, nothing going through OCI. We're told that depreciation and amortization are in operating expenses. Again, that might be relevant when we analyze the performance and we look at profit margins, etc. So on the SFPs, we've identified, we've got quite a bit of equipment, as you'd expect from a manufacturer. It's a tech business, so quite a lot of capitalized intangible assets there. Healthy cash balance, quite a lot of inventories. So the share capital. Interesting, they must have made losses in the past because there's a negative amount there in retained earnings. There's a suspense account, which is probably something we're going to have to deal with. And then, a bit of debt. We don't know what the share price is, but, not too high. And then we've got some current liabilities as well and a small provision. So quite useful to have a quick kind of skim through there, particularly when we're going to look at the performance and the position and analyze that. So performance, of course, looking at the P&L, position, looking at the SFP. Then we've got the sale and leaseback transactions. That's the first issue. So we're told because of a need to raise cash for research and development expenditure, ICAEW's directors decided to sell the company's freehold head office building for 1.5 million, its fair value, right at the year end. So at the year end date, leasing it back immediately. So obviously sale and lease back. So they leased it back from the building's new owners for a period of 11 years. So they obviously own the building, the land and the building. To raise finance, they sold it for 1.5 million, but obviously they still need the head office building, so they're leasing it back. So it's a good way for businesses to raise cash. They're selling their asset, but they still need to use their asset, so they sell it, they get the lump sum of cash in, and then they're going to lease it back, so pay rents over the next 11 years. So ICAEW does not have the option to buy back the building. So this isn't a sale and repurchase because they're not going to buy it back. Now, if it was a sale and repurchase, we might be looking at here is a financial liability because it's effectively, just like a loan. If they were going to, sell the building for, 1.5 million and then buy it back in, 2 years' time for 1.7, that's effectively, it could possibly be treated as a financial liability as a loan, depending on, the fair value of the building, the repurchase terms, etc. But they're kind of just ruling this out and explaining that there is no option to buy it back. This isn't a sale and repurchase, so you don't even have to worry about that. This is a sale and a lease back. The carrying amount of the building immediately before sale, so the carrying amount of the building just before they sold it, of course, this would have been PPE because it was a head office building, so it was property. The carrying amount was 1.2 million. The transaction qualifies as a sale in accordance with IFRS 15. So it is a genuine sale and they did genuinely sell the business and transfer control. So we're told that the receipt of cash of 1.5 million at the year end was debited to cash. So therefore it would be quite rare for them to get the cash entry wrong. Always assume that they've got the cash entry right here. So, and of course they have, ICAEW has received cash, debit cash, but the credit has gone to the suspense account, which is what we saw on the SFP. So just credited suspense accounts. We need to think, where should that credit have gone? Now, other accounting entries have been made in respect of the disposal of the building. So clearly they didn't know what to do with it. So the building's lease requires an annual rental payment of 57,000 payable in arrears every 30th of June. So, they've leased it back, at this date. The first payment is going to be on the 30th of June 23. ICAEW expects to continue to occupy the building, which has a remaining useful life of 50 years for the next 11 years. So they're going to occupy the building for the next 11 years. So the building has a useful life of 50 years, but of course they're only going to use it for the next 11 because it's an 11-year lease. The interest rate implicit in the lease is 6%. So therefore there's quite a bit going on here, and hopefully you're quite comfortable with lease accounting, and this was all covered in FAR. So when we've got a sale and a lease back, so as I've explained, the company sells an asset and then immediately leases it back. So don't get this confused with selling an asset and then having an arrangement to repurchase it, sale and repurchase. They're selling it and leasing it back. So if you know how to deal with a company selling an asset, so whenever a company sells an asset, so whatever that asset is, whether it's PPE or intangibles or a financial instrument, we'd have a profit or loss on disposal. So the difference between the proceeds and the carrying amount. Of course, if they sell it for more than the carrying amount, it's a profit. If they sell it for less, it's a loss, and that profit or loss is recorded in the P&L. So they have sold an asset, so we'd have to think about the profit or loss on disposal. And then, of course, they've leased it back. And when a company leases an asset, if, of course, it is a lease, if they've got the right to control that asset, which certainly appears to be the case here, because they're going to use it as their head office. There's an identifiable asset. Clearly there is here because there's a specific building, and clearly they're going to obtain the economic benefits from it because they're going to use it there as their head office. So clearly we do have a lease, and when you have a lease, you have a lease liability for the future payments and a right of use asset. So therefore we just need to think, what impact does this have? We know, a company sells an asset, profit, loss or disposal. When they lease it back, there's going to be a right of use asset and a lease liability on the SFP. Well, the complication here with a sale and a lease back is when you think about the sale, the company has only sold part of the asset because they've retained a right of use for the asset. So if you think about this example that we have here, so ICAEW had the building, so when they owned the freehold, they had the right to, use that asset, from today, until forever. So, they owned kind of every part of that asset because it was, the freehold land and buildings that they owned. So what do they own after the transaction? Well, what they have is the right to kind of use that asset from, today for the next 11 years. And therefore we know from this period onwards, then that is effectively what they've sold because they no longer have that kind of right to use the asset after that point. So hopefully you can kind of see what I mean when I say they've only kind of sold part of their asset because they had the right to use the asset kind of unconditionally, and now they've got the right to use it for 11 years. So they've effectively retained the right to use that asset, to control that asset from now until the next 11 years. So what they've effectively disposed of is this part of it. So hopefully that makes sense, and we'll see why this is important when we look at that profit or loss on disposal. Because what happens is they can only recognize a profit or loss on disposal for the part that they've sold because they've retained part of it. So, that makes sense. They've only sold part of it. So they can only recognize a profit or loss on disposal for the part that they've sold. So when we're trying to work out the profit or loss on disposal, we'd calculate it as usual, proceeds minus carrying amount equals profit or loss on disposal. But as I said, what we need to know is what was the value of the part that they sold? And the way we can work it out is we could work out what's the value of the part they sold, or we could work out the value of the part they retained. You kind of do it either way. Then what we would do is we would look to work out the value of the part that they've retained. We'd take the present value of the future lease payments as a percentage of the total value of the asset, and that would give us the value of the part that they've retained. So if we know what the value of this is from today for the next 11 years, and we can actually work that out because that's just going to be the present value of the lease payments they've agreed to make in order to use the asset, so we can get a value for this part, and we know the total value of the whole asset, then of course we could work out the value of this as well. So it'll be easier here when we look at some numbers, and I'll demonstrate this. But as always, don't get too dragged into the complicated bit first of all, because there's going to be some fairly tricky numbers here. So of course, remember the question isn't just calculate, the impact on the financial statements. It's of course explain. So it's explain the financial reporting treatment. So you do need to have plenty of narrative in your answers. Now, a good thing to do here would be to, when you have to explain it, then briefly mention the relevant parts of the relevant standard, just briefly. Now, this isn't a license to just dump lots of information from IFRS 16. Think very specifically about which part of IFRS 16 is relevant. So of course, we're looking at a sale and leaseback here. So you could have a brief point here about the sale and leaseback part of the standard. So we could say here, under sale and leaseback, we could say under IFRS 16, when company enters into sale and leaseback, only part of profit on disposal, so clearly you can have a profit on disposal here, only part of profit on disposal can be recognized or is recognized because only part of asset has been sold. So hopefully that's kind of clear, and that's a relevant part of the standard. We're thinking here specifically about a sale and a leaseback. We're thinking specifically about the profit on disposal, and how that can be recognized. So we said here, when the company enters into that, only part of the profit or loss on disposal can be recognized because only part of the asset has been sold. So you can see that's kind of quite abstract. We haven't really applied that to the scenario just yet. So then we can kind of move on and we can apply it to the specific scenario. So then we can think about how do we apply this to this specific scenario. So first of all, you could justify why it is a lease. Now, in other questions, that might be more important. There might be a bit more around what the asset is. Is there actually an identifiable asset here? Can't be substituted by the lessor. It isn't quite so much of an issue here. So we might want to be brief, but we can say agreement is a lease because ICAEW, you can maybe abbreviate that going forward to help save a bit of time, because ICAEW controls an identifiable asset. So of course, in this case, the building. So you can see how we're applying it a bit more to the scenario. We're just kind of justifying why this actually is a lease, first of all, and obtains economic benefits from it. And we could just put here, by using it as head office. So it's quite clear here, this is a lease. It's not as though the lessor can substitute it for a different building, or that it's got a it's particularly short term with no purchase option or anything like that. So then we can see we've kind of applied it to the scenario in that part. So clearly it is a lease and clearly it is a sale. So then we have to think about how much of this profit or loss on disposal can be recognized. So if we start to think now about some of the numbers that we would calculate here with the sale and leaseback. So as I said, when we're thinking about the profit or loss on disposal, now first off, calculate your profit or loss on disposal as you always would. So you'd have your proceeds minus your carrying amount, and then you get to the profit or loss on disposal. Now we know that the sales proceeds, we were told here that they were 1.5 million, and we were told that the carrying amount of the asset was 1.2 million. And therefore you think, okay, well, we've got our profit or loss on disposal here of 300K. Now we know, of course, that you won't be able to recognize, or ICAEW won't be able to recognize all of that because they haven't disposed of all of the asset. Now, what we need to work out is what part of the asset have they disposed of. So you can work out the value that they've retained. So you could say, part disposed of, by simply looking at the present value of the lease payments over the fair value of the asset. What we're saying here is this asset in total is worth 1.5 million. So, they've got this asset here, in total, which is worth 1.5 million. Now we've said, they've retained this bit and they have disposed of this bit. And we're trying to work out what portion of this have they disposed of. So as we can see here. So then it's hard to work out this bit. So we can work out this bit because we know that if what they've retained is the right to use it for the next 11 years, well, how much are they paying for that? So if we know the present value of those payments, because of course we know what they're paying 57K for the next 11 years. We know what they're paying for this part to continue using it. And we know this is a total value. So we could kind of work out what the part actually disposed of was. Now, of course, these payments, aren't all being made today. They're being made over the next 11 years. And whenever you've got payments which are made more than a year away, then we're going to need to discount them down to present value. It's very rare that you'd have a future payment that we don't discount to present value. If you think, financial instruments, we're discounting down to present value, leases, whenever you've got, a sale on credit, a receivable, which of course is a financial instrument, provisions where amounts can be paid in more than a year's time, you always discount it down to present value. So there's different ways we could go away and work this out. We've obviously got 2023 will be the first payment, and then it's going to be for the next 11 years. So we're going to have 11 payments in total. So you could do this the really long way and work out the cash flows for each year. There's obviously much shorter ways that I'm going to kind of show you how to do this. You could do it like this, and you could do your 57,000 and discount it each year. We're told that the implicit interest rate, of course, is 6%. So this would be, the long way to do it. Multiply it by 1, divided by 1.06. And if you've got the years there, this is quite helpful because you could just kind of put that in there, and then that should drag down because that will stay the same. So I should have just done a discount rate there. This to the power of the year, and then you can work out the present value. And then you should be able to just drag this down. I mean, you could link that to the discount rate as well, and just sense check that numbers are getting smaller and smaller as they get further and further into the future. So that would be a really kind of long way of doing it. Maybe we'll just work in thousands. That would be kind of a long way round of doing it. Of course, when you've got a constant cash flow, then you could use an annuity factor. So, the annuity factor would just be the sum of the discount factors. So another way would be to, take this and say we've got a cash flow from year 1 to 11. And then, of course, get the annuity factor, which you could take from annuity tables. So 6%, 11 years, 7.87, as we've worked out up here. So, of course, that would be quicker than discounting it down every year. That's quite handy to do it that way. Of course, you would need to be a whole number, well, unless you've got the annuity tables for increments as well. Of course, what we could do, and what would be the quickest way, but important to show your workings, would of course be to use the functionality in the software. So if you did the present value, we've got 6% as a rate, number of periods 11, payment is 57. And therefore you could work it out that way. So that would be the quickest way to do it. I suggest that you show your workings though. Remember, the examiners can't see what's in the cell. So I just put 57, 6%, 11, and then they can kind of see what you have done there. So that would obviously be the quickest. I think it's kind of important for you to understand what we've done here. If you go back to the basics just of discounting, then it perhaps makes it easier to, at least you can understand a technical underpinning for using the annuity factor, which is just the sum of the discount factors. And then, of course, the even easier way of using the function in the exam. So whichever way you use, we know that the present value of the payments for the next 11 years are 450K. So therefore, if we had an asset which had a value of 1.5 million and use of it for the next 11 years is worth this, because we know what the present value of the lease payments are, then clearly the value of the part they disposed of was worth this. So the quickest way to do this is just to say that the present value of the lease payments is the 450K, and if the asset was worth this in total, then you can see what they've retained. They've retained an interest of, once rounded, 30%. Because they had an asset which was worth this, what they've retained, the value of the part that they've retained, i.e. using it from now for the next 11 years, is 450K. So they've retained 30% of the asset. And if they've retained 30%, then of course they have disposed of 70%. And therefore the portion of the profit or loss on disposal they can recognize, of course, is the 70%, because they've disposed of 70% of the asset. So, they had the right to use it from today until forever. They sold the asset, but they retained use of it, for the next 11 years, and they disposed of effectively use of 11 years until forever. What we can value is the value of the part retained, because we know what they've retained, because we know the lease terms. And therefore we can say, what they have retained here, the value of what they've retained is, of course, those payments that they're going to make. That's like, the market value, if you like, of, the use for the next 11 years, the present value of those lease payments. So then we can know what the profit or loss on disposal is here. So we can kind of explain this in the answer. So we can say that, ICAEW has disposed of 70% of its asset, so can recognize 70% of profit or loss on disposal. And of course, always copy your workings over. Really so important you do that into the spreadsheet area. So depending on how you've done this, you could show all of them. But however you've done this, even if you've just done it this way, you could show how you've worked out the present value there. Probably label that up and just call it, present value of lease payments. The abbreviation like that is fine, and the examiners are, of course, professionals, so they'll be able to clearly see what you've done there. And then we've worked out, the profit or loss on disposal here, and we said that's kind of the profit or loss on disposal which can be recognized. So we've got the profit or loss on disposal, which we've said that they can recognize. So that's the first part you have to do, and that's perhaps a tricky part, but hopefully that makes more sense now as to kind of what we are doing there. So of course, they've leased the asset back, so they've still got a lease, and as we've said, whenever there's a lease, there'll be a right of use asset and a lease liability. So they'll have a right of use asset on the SFP because they've got the leased asset still, and they'll have the lease liability, as a company always does when they lease an asset, unless it falls under one of the exemptions, the very narrow list of exemptions. So we could say that ICAEW retains use of the asset for next 11 years, so has a right of use asset. Again, find abbreviation to use, and we can mention ICAEW has lease liability, as has obligation. So remember, that's what a liability is, isn't it? It's an obligation, has an obligation to make lease payments for next 11 years. So as we always do. So the only tricky thing here is, remember, the way you calculate the right of use asset is to take the carrying amount, multiplied by the part of the asset that was retained. Now we've said, of course, that they retain 30% of the asset. So what we will have here is our right of use asset will be, we've got the original carrying amount of the asset, which we have here. You probably even need to put that there again. But of course, they've retained 30% in the asset, so they'll still have 30% of the asset on the SFP. They only disposed of 70%. They have, of course, retained 30%. And then, of course, as with all rights of use assets, that will be depreciated over the period they'll use it. So we were told here that it's got 50-year useful life, but of course they're only going to use it for the next 11 years. So ICAEW needs to depreciate it over the next 11 years because that's how long for them they're using it for. So that's the lease term. So therefore they're going to have depreciation of this every year. I mean, this transaction happened at the year end, so actually we're not going to record any depreciation in the current year, but just so you're clear on that. And then we've got, of course, the lease liability on the SFP, and of course we've already worked out what that is. So under amortized cost, it's always the present value of those future payments, which we've already worked out, and then there'll be an interest expense every year minus the amount which is paid, and then we'd get to the carried forward amount. So whenever we measure things under amortized costs, whether it's leases, financial instruments. Again, very similar because it's looking at the present value of the payments. You discount the payments down to present value, and then you record the effective interest in the P&L. So whenever you discount payments down to present value, i.e. whenever there's a payment in more than a year away, then of course, as time gets closer and closer to the payment, you have to unwind that discount. So we've got the lease. We know the effective interest is, of course, the 6%. So then what will happen over the life of the lease is we'll effectively keep increasing the liability up so that it will equal the payments that will be made. So we're told that there's going to be 11 payments in total. So therefore, you don't have to show this full. All you have to do is the first year here, but just to kind of demonstrate, how amortized cost works. What will happen is we'll end up getting down to 0 when we get to the end of the lease. So you can see what we've done is discounted it down to present value, but we've unwound that discount every year. That's the interest which is recorded in the P&L, because that's the effective interest over the life of the lease. This is the actual lease payments made, and therefore that just clears the lease balance down to 0. And you'll be familiar with this from financial instruments, and this is covered in a lot more detail in the financial instruments class, how this works for, bonds, loans, etc. As well as, of course, in the leases class and in provisions and revenue, whenever we've got a payment in more than a year's time, discount it to present value, record the effective interest in the P&L. Therefore, we could copy our workings over. As I said, you wouldn't need to show this for, the first year. I mean, we didn't even really need to show what the depreciation was there either, because we're not going to record any entries in the current year for depreciation or the effective interest, because this is at the year-end date. So this is kind of like the carried forward lease liability at the year-end date. That was just more for completeness there for your own understanding. So we've explained there, that they'll have a right of use asset, and therefore that they'll have the lease liability. Now, what's also good to do in these questions is to explain why what they have done is incorrect. Now, obviously, it's quite clear, they've made a mistake here. So we started off with the relevant parts of the standard. We've then applied it to the scenario, and we've said how this should have been accounted for. So we've briefly started and said, under IFRS 16, only part of the profit or loss on the disposal should be recognised. And then we've applied it to the scenario saying it's a lease. We've worked out what portion they've actually disposed of, what profit or loss on disposal should have been recognised, and that a right of use asset should be recognised as well, and a lease liability as well. But what's also good to do is explain why what they have done is incorrect. So as I was saying, it's quite clear what they've done is incorrect because they've just put it all in suspense account. But sometimes in other questions, it might be that they've recorded all of the profit or loss on disposal in the P&L. Or we're looking at a later year and they've recorded the lease payment in the P&L rather than the effective interest and the depreciation. We could just say here it was incorrect to record in suspense account because ICAEW needs to record profit or loss on part disposed and profit or loss on part disposed, right of use asset on asset controlled. Because of course, when a company controls a resource, that will be recorded as an asset, such as a right of use asset. So they need to record the profit or loss on a part disposed, right of use asset on asset controlled, and lease liability for obligation to make payments. So just kind of explaining why what they have done is incorrect, which is obviously quite clear what they had done there is incorrect. And then what we can do is explain the impact on the financial statements and show the journal entry, and then correct any draft financial statement figures if required. Not all questions ask you to redraft the financial statements. Obviously, this question did, and therefore that's why we're going to do it in this question. So what we need to do is we've kind of already explained the impact on the financial statements because we've said that they should have recorded, or I should say, well, so can recognise, so we say must recognise 70% of the profit or loss on disposal. It's obviously not optional. So then we can think about what the journal entry would be. So therefore, you might look at this and think, wow, this is going to be really difficult because there's a lot of entries. There's a right of use asset, there's a lease liability, there's the profit or loss on disposal. But what I would say is just take it kind of one entry at a time. I mean, one way you could do it is start off with, what they did, because of course they just debited cash, and we know that bit's right. So they debited cash for the proceeds of 1.5 million, and the credit went to the suspense account, which of course we know is incorrect. So let's think about what they should have done. So cash is always the easy entry, isn't it? Because has the company received cash or paid cash out? So that's nice and easy. Now, what should they have done? Now, like I said, there's a lot of entries going on here, but just take it one at a time. And even if you got one of your numbers wrong, you should be able to get the others correct. So what should they have done? Well, they should have recorded the proceeds here. Now, we know they should have de-recognized the PPE because this asset, which is included within PPE, is no longer, it is still kind of an item of PPE because you can show your right of use assets as part of PPE. What the company has done, it's got its PPE included here. So we kind of take it out of there because they no longer got that asset, and what they have instead is a right of use asset, even though it's on the same asset and you could include it within PPE. But rather than kind of showing it as kind of a net adjustment, probably easier to just take the PPE out as a whole. So we take the PPE out here. Now we know with the profit or loss on disposal, they can't recognize it all. They can only recognize a certain amount. So we put our debits here and our credits here. And we know that with the profit or loss on disposal, they should only have recorded this in the P&L. So what do they have with the right of use asset? Well, we know they should continue to recognize, or they should now recognize a right of use asset for the asset which is leased. So obviously the same asset, but that's the value of the right of use asset. And we know, of course, that there is the lease liability, which is initially recognized as the present value of the payments. And therefore, you can see, this is what, and that does balance. So it's quite easy, start with the cash and then take it one by one. They have disposed of that item they've currently got sitting in PPE at a freehold building. What they have instead is like an 11-year lease. You've got the right of use asset and the lease liability. And this is the part of the profit or loss on disposal that they can recognize. So that's what they did record. And this is what they should have recorded. So clearly we know there shouldn't be anything in the suspense account. And of course we know, that should be taken out. So therefore we're going to debit the suspense account, and we know they haven't recorded any of these entries. So it should simply be a case of just including these entries, and we should be able to get that to balance. So we've got the PPE, the profit or loss on disposal, because none of these have been recognized at all. And we said, they should all be recognized. And therefore you can see that's all we need to do there to get to those correcting entries. So you could show all your workings, probably best to, in my opinion, if you've done the workings, show them, because there might be something in there that you get credit for, which you might not have got right down here. But you could just put here correcting entries, just so the examiners are clear. So hopefully, that's quite clear. As I said, in other questions, in other lease questions, it might be that they recognize all of the profit or loss on disposal. So they'd recorded too much of a profit or loss on disposal in the P&L, and then actually already removed the PPE. And therefore, you just have to adjust the profit or loss on disposal, record the right of use asset and the lease. It could be that they lease started at the start of the year and they've recorded the lease payment in the P&L as interest. So you need to take that out and record this and the depreciation. So they could come at this topic from different angles, but just think, what should they have done? What have they actually done, and how you can correct it? And if you take it one entry at a time, I think it's more manageable rather than trying to look at it all together. Maybe just think, well, the cash is easy, then that was fine. They should have de-recognized PPE they should have only recognised part of the profit or loss on disposal. And then, of course, they've still got a lease. So they've got a right of use asset and a lease liability. So then, of course, once we have done that part, we said, the next part to do would be to correct the draft financial statements. So hopefully you can kind of see now what I mean when I say it makes sense to do this part of the question, as you go after you tackle each issue, because we've just explained the treatment for leases. So of course it makes sense now to overlay those numbers onto the draft financial statements. So we've got our financial statements here. Now, rather than moving on to issue 2 and dealing with share-based payments and then moving on to issue 3 and then having to come back to this and trying to work out exactly what's going to impact what and have to switch back from financial instruments back to leases, that's going to take a lot more time overall. All that kind of transitioning between one issue to another is going to be quite a lot for your brain to take. So if you've got to do several requirements on the same issue, do everything on that issue. While I head switch on to sale and leasebacks, then let's just deal with everything we have to deal with in this whole question on sale and leasebacks, and then we can put it to bed. And you're not going to have to look at it for the rest of your exam, possibly for the rest of your life. So then we could think about what impact is this going to have. Well, we said, of course, they should have recorded a profit or loss on disposal. So that would impact the P&L. So maybe deal with kind of the P&L first. So we know that this should be recorded in the P&L. Profit or loss on disposal, probably go through some sort of, exceptional item. I mean, you could include it, in operating profit, or you could, leave a line here, put profit or loss on disposal. It might be disclosed separately. I don't think it would matter too much if you included it there in the operating profit. So of course, this is going to increase profit for the year. Now, of course, if something's going to increase profit for the year, that's obviously going to feed through and impact, profit after tax. So it's going to increase, the profit before tax. It's going to increase, the profit after tax as well. So of course, if something goes into profit after tax, then what happens to that, at the end of the year? Of course, that's transferred into retained earnings. What goes through the P&L, of course, is transferred into retained earnings. So if profit increases, then retained earnings is going to increase by the same amount. Similarly, items which go through the OCI, so for example, revaluation of PPE, and that goes through OCI, and that accumulates in the revaluation reserve. Fair value through OCI financial assets accumulate in the reserves. Anything which goes through any income statement, so the P&L or the OCI, will accumulate in reserves. And therefore, if you're going to make an adjustment to profit, make sure you follow through and show what impact it has in equity as well, if you're required to prepare the SFP, of course. So if profit increases by 210, then of course retained earnings are going to increase by 210 as well. So if we had a revaluation of PPE in one of the later adjustments, that would go through OCI. And then of course that will also increase the revaluation reserve, in equity, perhaps not relevant here for this question. So it's really important you follow through your adjustments from the income statements, whether that's P&L or OCI, into reserves. It's been commented that lots of students fail to do this. So that was the first adjustment that we had, because we said they should have recorded the profit or loss on disposal. And then we've said, of course, it's suspense accounts. That's a nice, easy one to take out. So I think that's going to be it for the P&L, because we're not recording any finance costs for this year because the leaseback has only just occurred. Of course, next year they'll have the finance expense and they'll have the depreciation expense on the right of use asset, but we're at the year end date. So of course, we know they shouldn't have had the suspense account in there. So that will be taken out. PPE needs to be reduced by the carrying amount. So they kind of just left it in PPE. Now, of course, they've got a right of use asset. So you could possibly show it separately. It can be shown as part of PPE. So as I said, you could kind of show this as kind of like a net, but I would definitely show it separately, at least in the workings. So we'd have the right of use asset here. I think that was 360 right of use asset. And then there's a lease liability as well, which is the 450. So you may have kind of put this, lease liability here in at the 450. Of course, strictly what you should do is part of this is a current liability. So the amount which will be paid in the next year clearly is the 30, and then the amount falling due after a year is 420. So strictly speaking, you should do it like that. But I think you'll still get some credit if you did have it all in non-current, or at least you've got the other entries all right as well. So hopefully that's kind of quite clear how to then follow that through into the financial statements. So as I said, this is quite a common question in that you have to explain the financial reporting treatment and then redraft the financial statements. In other questions as well, you have to go on and identify the audit risks in question 1 or 3, and then sometimes state audit procedures or identify weaknesses in procedures already performed. Of course, this is a question 2, so you're not going to have any audit here. Those are covered in a separate class. So again, hopefully you can see why it made sense to do it like that. And then let's move on to the next issue, which is share-based payments. Because like I said, we've done everything we need to with the sale and leaseback now. You can forget it. You've done everything. It's not as though you kind of explained it first of all, and then you're going to move on and explain share-based payments, and then explain the loan, and then have to come back and trawl through all of your workings trying to work out exactly what's going to impact the draft financial statements. It's going to be so hard. Believe me, by the time you've gone through IFRS 2 and applied that to the scenario, and IFRS 9 for the loan, and apply that to the scenario and calculate the numbers, if you had to come back to this, you would have forgotten what the issues were, and it would be difficult to kind of go through your workings. So it makes much more sense to, if you have to explain the financial reporting treatment and for the next requirement, correct the draft financial statement, it makes more sense to take it one issue at a time, explain, briefly mention the relevant parts of the standard, apply it to the scenario, calculate the numbers, do the journal entries, and then overlay the numbers. And then we're kind of done with leases. We can put that to bed and move on to the next issue. So hopefully, that's quite clear how that exam technique works. And you can, move on to, the next issue there you'd have to deal with for the next part of the question. So, what else could we see, on leases questions? Like I said, it might not be a sale and lease back. It might just be, a straight lease, but maybe there's some issue about, is it actually a lease? Do they have the right to control the asset? Is there an identifiable asset, or can the lessor substitute the asset for their own benefit? Does it perhaps come under one of the exemptions? So there could be kind of issues around there. Is it actually a lease? Maybe some more complications about, some of the incentives. Maybe there's a provision in there as well, perhaps. And then if it's a sale and lease back, of course, we kind of looked at this here, but maybe rather than just dumping the payment into suspense account, maybe they recognize the profit or loss on disposal, but on the full amount, and therefore there's too much profit in the P&L. Or like I said, with leases, it's quite common that they record the lease payment in the P&L. Quite a common mistake for one of the accountants to make. Possibly a sale and lease back when the proceeds are more than fair value. So just a couple of adjustments there. It's very similar to what we've just done there. You just have to tweak the profit or loss on disposal, making sure that you use fair value. And because the excess sales proceeds are effectively treated as additional financing, when you calculate the part of the asset that has been retained, then you would just reduce the present value of the lease payments by the difference between the sales proceeds and fair value. So your workings would be exactly the same. It's just this number you'd have to make sure is at fair value, and this number here would be reduced by the difference between what the sale proceeds actually were and the fair value. So there's just a couple of tweaks there. And then the scenario where proceeds are less than fair value isn't examined, but we have included there in the notes just for completeness, because of course I know so many of you have an inquiring mind. So hopefully that's kind of given you some useful tips on tackling question 2. So what I'll do is I'll just give you some other kind of useful advice on preparing for your exam. So I suggest that you break the exam down into topics and question types. So you can kind of see here what I did. I just focused on leases. I just focused on one question on leases. And I think that's a really good way to approach the financial reporting and the more general audit risk and procedures type questions. Break it down into smaller topics and just focus on one topic at a time. So like with leases there, for example, I haven't taught you the technical content, we get limitations in this class, but for example, in my video classes, what I do is I explain the technical content in a nice, easy to understand way. Once you've understood that technical content just for leases on their own, so looking at leases, sale and leaseback, etc., you've understood why we account for things in the way that we do. Once you've understood that technical content, then what you should do is go and practice several questions on it, one after the other. So focus on leases. How long is it going to take you to go through leases? Watch a video or read the relevant parts of the ICAEW workbook. Understand that key technical content. Have some summarized notes that you're going to use in the exam in case there's something you need a reminder of, a particularly technical point, like a sale and leaseback, for example. Once you've done that and you're comfortable with the technical content, then practice several questions on it. Because what you'll be doing is you're actively testing yourself on that content you've just learned. So you've kind of got it in your brain, you understand it, but then if you do questions on it, then you're actively testing yourself on that knowledge. And the best type of questions to do are, of course, exam questions, because they're the types of questions you're going to have to answer on exam day. So you're actively testing yourself. You're actively testing yourself in the environment that you're actually going to be examined in. So that is absolutely the best way to test yourself. So with leases, it has come up fairly frequently. So these are some questions here that you can go away and attempt. Several of these are covered in my video classes and in my live classes. But here are some questions on leases. So after this class, you can go away and practice, several of these. Some of them had a sale and leaseback. I think that one might be a sale and leaseback. This was more one around an issue of whether it was a lease or not. I think this was a sale and leaseback. I think that was a sale and leaseback as well, as was this one. Can't quite remember off the top of my head what that one was. But again, go away and practice several questions. You don't have to do them all now. Go and do a few now and then do the others when you're going to practice, when you're going to revisit the topic again. So what this will do is you'll go away, you'll understand leases, you've understood the technical content, you thought about the audit risks and procedures around it. You're comfortable with the content, and then just go and practice several questions, just like I did now. You can just do that one issue, get a feel for the question, look at the requirement, see what you have to do. Probably quite common like this, explain the FR treatment, redraft the financial statements, set your answer up as I have just done then, and then just practice the leases part of the question. And then go to the next leases question and do the same. And you're actively testing yourself on that knowledge. You're making your whole preparation approach much more manageable because you're just doing it one topic at a time. There's so much content for corporate reporting. You'll be overwhelmed if you do it any other way. And of course, you're familiarizing yourself with how it's examined. You'll see the little things that the examiners, put in there. Like maybe you made a mistake and didn't realize this was at, the year end date, and you included the depreciation for the year and the interest expense on the lease. But you'll learn from that and you'll pay more attention to this point next time. So really useful approach, and then move on to the next topic. Now, I probably wouldn't start with leases. I don't think it's probably it's not the most logical topic to start with. So if you go to the corporate reporting page on the ACA Masters website, you'll see how we structure our corporate reporting course. You can get an idea of how you might want to structure the topics. I'd probably start with assets, because of course that's quite relevant for leases as well. So, maybe do assets as a topic, revenue as a topic, provisions, financial instruments, hedging. Break it down into these smaller topics. And then for each topic, what you should go away and do is understand the key technical content and then practice several questions on that topic. So you just go through and master it one topic at a time. Assets mastered, revenue mastered. Understand the key technical content, practice questions, work on your exam technique, test yourself on that knowledge, and then you will master it, one topic at a time. So that's the way I suggest approaching the financial reporting and audit. Risk and procedures questions, that probably covers a majority of questions in the CR exam. Financial statement analysis is, of course, a topic a question type we've seen today. So again, I'd treat that as a kind of like a discrete question type and practice several of those questions one after the other as well. Of course, my video class for that, I teach, the exam technique to use for the two different types of financial statement analysis question. And again, teach key technical content, work through some questions to show you the exam technique to use. And then you go away and practice several questions one after the other, just as we have done there for that question. So not all audit questions are audit risks and procedures. You do get some other audit questions, so maybe focusing on audit approach or non-audit, so assurance engagements or reporting. But again, same thing, probably less standardized, these types of questions, but there is an exam technique that you can use there. So break those out into separate types of questions. There's, of course, the inflow questions as well. So, one of those is available to practice on the ICAEW website. There's the mock exam elephant as well. So you could do several of those questions one after the other. But again, that's, I think, one of the questions we've had come in actually is, what's the best approach for preparing for question one? Again, it's the same as with the other questions, really. In the class, I'll explain the exam technique to use for these types of questions, and I'll work through a couple of them, or the two available ones actually. There's elephant, isn't there, and there's the July 21 exam. I'll work through it, and then you can go and practice that same exam technique. But I do appreciate you are a bit limited with question one, because obviously there's only a few questions for you to practice there. I'll pick up on some of those other questions shortly at the end. And again, ethics as well is another question type. So do a whole batch of ethics questions, one after the other as well. So hopefully you can kind of see how that approach would work. So I've just done it for leases. After this class, you can go away and practice several leases questions one after the other, and you'll see how that approach works. So you gradually master it one topic and one question type at a time. So for each topic, question type, understand the content, practice lots of questions, master it one topic at a time, and then eventually you'll be ready to sit full exams and bring it all together. So I suggest that you do your questions in the software as well. So it's also just worth touching on SBM here as well, because I'm saying about the different question types. So there are quite a bit of overlap with SBM. Of course, one question type in SBM is financial reporting, explain the FR treatment. So I would suggest, if you're preparing for SBM as well, try to kind of like marry the two up. So in your kind of study plan, I would allocate a day or a study slot to each topic. So, maybe Monday evening leases, for example. But if you're doing SBM as well, then when you're kind of allocating the various SBM topics to your study plan, you kind of like try to leverage off the overlaps by, if you're doing the financial reporting treatment on leases for CR, do some of the financial reporting treatment questions on leases for SBM at the same time. Because to be honest with you, they're fundamentally the same question. They come from a different angle, a different scenario. SBM's, of course, more commercial scenarios, CR, of course, more audit, but the questions are very familiar, very similar. The performance analysis is quite similar to the financial statement analysis in CR, and of course, ethics as well. So these are kind of the topics for SBM. These are the topics for CR. So when you're building your study plan, so that you're allocating a topic to each study slot, make sure that you kind of take this into account so that you can pair up similar question types, similar topics. So when you're practicing questions and on exam day, a few tips here. Make sure you allocate your time. So make sure that you attempt every question. I explain that in detail. It's really important that you get through every issue. So of course there were some tricky bits on this leases question. If you did run out of time, maybe you didn't kind of perhaps finish all the journals, or maybe you found working out, part of this was quite tricky. There's still plenty of other marks you could get. So make sure you get the easy and the medium marks, and make sure you attempt every issue so that you can pick up the easy marks on each. So it kind of ties into there. Make sure you use a scenario to answer the requirement. In these advanced level exams, the examiners want to see you reacting to the specific scenario. So you can see here that even when I explained the relevant part of the standard, I kept it very focused on a sale and leaseback, and what part of the profit or loss on disposal can be recognized that's focused on the scenario. And you can see here, my point, mentioning the company name is, of course, quite an obvious thing to do to keep it applied. But even when I'm talking about the asset, I've mentioned the building because that is the asset in the scenario, and using it as a head office, again, in the scenario. So just important to do that. That's particularly important for the less technical topics, and you'll see that in some of the other classes. So I suggest using a short, concise writing style. So the answers you may see in the back, obviously, can be quite detailed. You don't have time to do this. Short, concise points, straight to the point, leave a line, move on, make it easy to mark. This, I'd see this as kind of like a model answer, really. You shouldn't be writing in big, chunky paragraphs. You'll see in some of the examiner's comments as well that they have mentioned how students who tend to write like this tend to actually score higher marks. So I've mentioned you don't always need the hard marks, so there are some headroom marks there. And I suggest that you use your notes for niche areas. Of course, you might go into the exam thinking, right, it's open book, I'm just going to look up everything up in the exam. It's so time pressured, you haven't got time to do that. So I suggest be very selective about what you're going to look up. Even before the exam, probably go in, already having decided in your mind what you're going to look up. So for example, sale and leaseback, maybe you're going to look that up, particularly if the proceeds aren't at fair value, because that's a very technical kind of niche area. Maybe share-based payments where there's a choice of settlement, that would be another area that I would look up in the exam, just as a quick reminder on that. So in terms of other resources that we have, I hope that you have found this class useful. I'm running live classes on Saturdays where I'll be working through lots of exam questions, past exam questions. We've got video classes available. So we've got this for every topic and every question type for CR. So we've obviously looked at leases today. I didn't teach you the technical content, but teaching the technical content is included in those videos. But cover all of the different topics, as you can see, particularly popular ones, hedging, tax, frequently examined at CR and areas that students struggle with, financial instruments. So in all of these classes, I teach the key technical content in a nice, easy to understand way. And then I work through some questions so I can show you the exam technique to use. So I cover every topic, every question type in there. And then after you've watched the class for each topic, you then just go away and practice several questions, one after the other. So of course, we also have our materials available. So they're available to purchase further down the page, as well as the advanced information analysis when that comes out. So when the AI is released later in June. So of course, having these notes, you've got the key technical content for each topic, the financial reporting content, and of course, audit risks and procedures and reminders on the exam technique to use. So they cover all of the topics and all of the different question types, and it includes my model answer as well to the July 21 exam. So I worked through that exam in full, and my model answer is there. One of the video classes as well, you can see me work through question 1. So that's the data analytics software question for that. You can see me work through that in full. I know that's an area where students are a bit concerned about how that might play out in the exam. You can see me work through that in full. So we've got lots of resources for CR, and then of course my live course as well, which starts on Saturday. So as part of the video course, you can actually watch one of the classes for free. You can see we've got this free sample class below. So this one's on assets. So, if you found this class useful, I suggest, go and watch that one. That's free to view. So that's available to ACA students. So you can watch that where I explain the key technical content and work through some questions. So again, you'll find that useful in terms of me showing you how to answer the questions, writing style, how to use the notes, etc. So I'm quite active on LinkedIn. So I regularly post exam tips, topics, sometimes some of the notes which we allow students to download. Sometimes we post parts of those on my LinkedIn page and on the ACA Masters LinkedIn page. So yeah, please connect with me. That'll be nice to do. And then we've got the blog on the ACA Masters website where there is some useful advice there on corporate reporting. So you can go onto the blog there for that. So what I'll do is I'll just launch the poll. So I'd really appreciate it if you wouldn't mind just filling this out quickly so we can understand whether you would like us to run more of these events. And then I'll take some questions. Okay, thank you very much. Well, the last few just fill that in. I'll start to take some of the questions. So I think I've answered the question there on question 1, how to prepare for that. So how common are cash flows and statement of changes in equity? Not that common, but it's absolutely content that you need to understand. You need to be comfortable with how a cash flow statement is prepared. Now, it's highly unlikely you're going to have to prepare a full cash flow statement. That's very much FAR, but you might be required to interpret one. So I think there's been a question before where there was a cash flow statement. I think there's been a few questions actually, and you were analyzing like the position of the business. Because of course, when you're analyzing the position of the business, one of the things you're absolutely going to look at is cash. So it might give you, the SFP and all you've got is the cash balance, but actually you might have the cash flow statement and you can kind of see what the company is spending cash on. So being able to interpret a cash flow statement is, I think, going to be more important in corporate reporting rather than having to prepare one from scratch. Statement of changes in equity, again, you could be given an extract from a statement of changes in equity. I haven't seen it come up in corporate reporting, but you do need to be very comfortable with the equity balances. And actually, as long as you are, then a statement of change in equity shouldn't intimidate you in any way. Of course, if you understand what all the equity balances represent. So when we look at groups, we're going to see a lot on calculating like the carry forward NTI balance and things like that, which of course is just the same as you'd see in a statement of change in equity. So question whether we need to charge depreciation for the lease, not in this question, because the lease was taken out on the last day of the year. So it'd be depreciated, going forward. So are these CR materials ordered based on the course structure? Yes, because they've got all of the key technical content by topic, financial reporting treatment, and also audit risks and procedures, and it covers all of the other topics as well, the other audit questions, financial statement analysis, etc. So the question is, with respect to free drafting the figures for question 2, do you recommend we redraft the figures one by one before starting the question 2, just as to save time? Do you have any tips? So as I did there, I suggest that you copy the draft numbers, first of all, from the exam paper into here, and then you could have issue 1, 2, and 3. And then as you go through each issue, as I did there, explain the FR treatment for issue 1, then immediately after overlaid it onto the draft financial statements. Yeah, so the data analytics questions in the exams, that's covered in the data analytics software classes. So there's a whole class on those. I'm afraid I won't be able to kind of go through all of that now, but we've got several classes on that. So in this one, I worked through the July 21 exam, so I recommend that class. So the advanced information, the release dates on the ICAEW website. So what advice would I give to someone who attempted CR and got 48%? Well, whilst you may take the view that you were close, and you certainly were close, and you were unfortunate in some ways, there is quite a bit that you didn't get right. There's quite a lot of marks you left on the table. So you could say I only needed 3 marks, but 2 marks. But of course, there's all of those other marks as well. So I would take it back to basics, and even going back to the FAR content. So take it one topic at a time. Make sure you're comfortable with all of this brought forward content, because there can be a lot of gaps in students' knowledge, and it's quite common that the exam examines some of these brought forward topics. So take it one topic at a time. Make sure you understand the key technical content, understand the exam technique to use by watching me work through several questions, and then go away and practice several questions on that topic, and just take it one topic at a time, master them one by one. So you can go away and watch the assets class, you can watch the FAR recap class, you can then watch the CR class, you can see me work through some CR exam questions, and then you can go away and practice several questions on assets. And then master that topic and then move on to the next one. So take it back to basics and do it one at a time. So our draft mock exam paper that I've shown here, we're currently working on those, so they'll probably won't be released until later this year, probably more 2023. So the audit questions do tend to be vague in nature. Yes, they are kind of quite different. They are quite different. But there is a certain exam technique you can use. So that's covered in detail in these classes. So there's weaknesses in audit procedures class, and also these other CR audit questions. That's when I tend to work through those other audit questions. Will that be okay if I spend more time on some big requirements and give detailed answers and give up a couple of sub-requirements in the last question? No, I suggest attempting every part of the question so that you can get the easy marks on each. So for the redrafting, can you copy from the exam software? No, I suggest that if you copy from the exam software, it will save you time rather than inputting the numbers one by one, because that'll be quicker. That will help save you time. So in terms of ratio of numbers to words, I wouldn't necessarily think of a ratio. I mean, for this question, you can kind of see what was right here, but it's going to vary. Some of the questions are going to have less numbers than this. So there isn't really a set rule for the ratio of numbers to words. It very much depends on the requirement and the topic. So will I be in a session on the data analytics questions techniques before the exam? So we've included that here in these video classes. The live course will have a class on data analytics software and the July 2022 advanced information. So the video course includes, and sorry, the video course will include that as well. So the video course includes me working through the July 21 exam, showing you the exam technique to use for those data analytics software questions. And there's a class on Elephant as well. And then there will also be a later video released after the AI has been released, where I'll be identifying the key financial reporting and auditing issues from the data analytics software. So that will be released on this date, specific to the July 22 AI, but these classes are available now. Okay, so thanks everyone very much for joining, and I look forward to helping you with any other CR classes we have available.